Hi guys, so in this session we are going to discuss and decode RTP September 2024 of Advanced Accounts. Just a short 1 minute intro before we get into the discussion. First, how we are going to study this RTP is how I used to study as a student, because RTP is something you study towards the end of your preparation, meaning once you studied the entire syllabus, once you have watched marathons 10-15 days before exam, once you are ready for the exam preparation, it is around that time you go and practice RTP for doing new questions. So first, once you know the concepts well, that's how I used to study RTP. That is how we are going to do it in maximum 1 to 2 hours. This session will be there. Okay, this is how we are going to do the RTP. How I study, we are going to do it. Second, some chapters questions or RTP is not there this time, like consolidation, then amalgamation, internal reconstruction, schedule 3, and cash flow is there, but only classification. They don't have a full-fledged direct or indirect method cash flow. So these big chapter sums are not there in this RTP. So students might get doubt, sir, does this mean in exam also this will not come? Not at all. This time RTP they are focusing more on accounting standards. So 90% of the questions in our RTP are accounting standards, and good news, there are a lot of new sums. Usually in the old RTPs in old syllabus, lot of repetitive questions used to come, so students used to skip. This time we have a lot of new sums in the RTP that we are going to solve. So this is the first introduction. 1 to 2 hours we will take. These chapters are not covered in this RTP. Remaining AS, predominant of them are over there. How we are going to do it is, follow guys, very simple. For every question, MCQ or main question, whichever concept they are going to test, I will just give a 5-minute introduction to that concept, theory introduction to that concept using our notes over here, or we have our accounting standard material that all of you have it or find in the description over here, the notes that we usually use in our class. Okay, so I will just give a quick theory intro and then we will straight away go and solve the sum in the RTP. This is how we are going to do it. So introduction, concept, and straight away get to the sum. This is how I also study. When I am studying something, quickly 1 to 2 hours revise that concept and go there. So this will be like revision plus solving all the sums for you. Additionally, last bonus, sir, I want full revision, sir. This RTP is only 1 to 2 hours. No, sir, full revision. We also have our marathon already available on YouTube. All you have to search is Advanced Accounts Marathon and you will find 20 hours of content marathon for full syllabus revision, all the AS. My suggestion is, if you have not watched this marathon, if you have the time, go watch this marathon, get one full refresher of all the concepts where we are going to do it using this material only. Then in the last 1 hour, if you can come and then solve all the questions of RTP, it will be like a refresher. 2 days, 2.5 days, advanced accounts is done with full revision of concepts and RTP practice. So this is my small introduction. Watch till the end guys, because there are a lot of new questions we are going to start discussing. Let's go in the same order what is there in RTP. Question number 1, MCQ. I will read the questions in brief. If you feel you need more time to read the question, pause the video, read and then come back. Suman Limited is in the business of manufacturing electronic equipments and selling this at various outlets. It provides installation service for the equipment sold with 1 year warranty. What electronic equipments? For example, let's take AC. They are selling AC and they are also installing AC and giving 1 year warranty. Just taking example of AC. Second paragraph, if you read, beach resorts, it purchased 5 AC. They have purchased AC only guys for its resort. Suman sold 5 AC for beach resort, each at 45,000, each one at 45,000, which includes installation fees, 1,000 rupees for each AC. The company also offers 1 year warranty for any repair. So 1 year warranty is provided. Company also offered 500 rupees per AC as a trade discount. Because you are purchasing in bulk, they are giving some discount. Beach Resort placed order on 15th of March, perfect. Made payment on 20th of March, perfect. And delivered on 27th of March. So everything is happening before 31st March 2024 and the installation was completed on 5th April. Now what concepts are they testing here? They are now testing basically AS9. AS9, if you see guys, standard talks only about two concepts. What is revenue? When do you recognize revenue? Here they are not questioning what is revenue, they are questioning when do you recognize revenue. Revenue recognition depends on, if you go to our notes quickly, if you just go to AS9 notes guys, yeah, if you look at this, recognition of revenue predominantly depends on what we would have studied already. Revenue recognition depends on two things, general conditions and specific conditions. General is for all sale of goods. General means there should be no uncertainty in amount, no uncertainty in ultimate collection. Here amount is certain, ultimate collection is certain because sale is done, payment also is received. Specific condition, rendering of service and sale of goods. Here two things is there. AC is sale of goods, installation is sale of service. What is the standard saying for rendering of service? Service involving single act, one time act like Swiggy delivery or watching a movie, you will use completed service. So once the service is completed, you will recognize the revenue. Multiple acts na proportionate percentage method. Sale of goods means very simple. When the ownership is transferred to the other person, in other words, when risk and rewards are transferred to the buyer, you will recognize the revenue. Remember guys, we don't care about delivery, we don't care about payment, we don't care about invoice. The term used in standard is risk and rewards are transferred to the buyer. This is the core concept. And remember, what is trade discount and cash discount? Very simple. Let me prepare two trading and P&L account. Let's say this is one P&L account. Sale is 500 rupees, 50 rupees discount. So I am showing 50 rupees discount here. Net you paid 450. Second, showing only 450 as sales in my trading account, where here itself 500 minus 50. Recognizing sales net of discount is at the time of sale itself. When you are doing the sale itself, if you get discount, that is called trade discount. If you get discount later after sale, if you get the discount, that is called cash discount. Here we are getting the discount at the time of sale itself. This is the brief of the question. Let's quickly go and solve this question. How much revenue should be recognized as of this day? Look at this. Each AC is for 45,000 rupees. So each AC is 45,000 into 5. And they are also saying this AC 45,000 includes installation. Now in this question, goods are sold this year, but installation is happening only next year. So I have to remove 1000 on installation into 5, and company also offered 500 per AC as trade discount. So I will again reduce 500 into 5 and recognize the net. So if you see 45,000 into 5 gives me 2,25,000 minus 5,000 you will reduce for service, another minus 2,500 for 2,17,500 is what you get. This will be your answer for this year. What is the revenue for next year? This is 23-24. What about 24-25? The revenue for 24-25 will basically be this service income installation, which the first answer itself is 5,000. Other answers I don't care because only the installation will be taken. What will be the accounting for trade discount? Now the same is recognized separately in P&L. No, we don't recognize. Are deducted and determining the revenue. Yes, trade discounts are reduced. See here, 450 we are reducing trade discount. Trade discount will be recognized after 1 year. No, we never read a provision like that. Trade discount will be recognized after installation is complete. Nothing like that. Answer is 2. Trade discount will not be recognized in the books of accounts. It will just be reduced from the value of sales. Next, is the company required to do any accounting for 1 year warranty provided by it? Now follow guys. Warranty concept where we study in accounting standards, it comes in AS 29 because warranty is part of your provisions. Sir, what is warranty? Let's say from Samsung you are purchasing an iPhone. How can you buy iPhone from Samsung? I am just seeing if you are all focused, guys. From Samsung you are buying one S24 or S25 Ultra for 1 lakh. Okay, 1 lakh. And they told they will give you 1 year warranty. So cost of warranty is 5,000. What Samsung will do, in year 1 they will put sales as 1 lakh and put provision for warranty 5,000. In year 2 what they will do, this 5,000 provision for warranty will be reversed. Why it will be reversed? Because nobody claimed warranty, 5,000 will be reversed. So effectively 95,000 is the revenue for first year and 5,000 is the revenue for second year. So now that is what AS29 says. Provision should be debited to P&L for warranty. Once the warranty period is completed, we will reverse it. So look at the options. Look at option B. As there is a present obligation to provide warranty to customers for 1 year, I need to create a provision as per AS29. None of the other options talks about AS29. So the answer is 2. Okay. Let's proceed, guys. Next, general MCQ. We are going to go to the second MCQ. During the marathon, guys, after 1 or 2 questions, I will keep drinking or sipping some water so that I don't get throat pain and you get more videos from me for studying. Okay. So just giving a excuse in the start itself for this. Next, general MCQ. I hope everything is going well, guys. You understood the first question? If not, let me know in the comments and we will try to clarify by text whatever doubts you have. As per AS2, inventories. So let me go to inventory notes. Okay. For everything we have our notes, guys. This is from ICAI, summarized and made in our style. Okay. As per AS2, inventories include materials awaiting use in production process. What should be included in inventories from the following? Okay. Inventory, what should I include? In our notes, if you see, it will be given in inventory. What is included? What is included? Look at this. Inventory includes what? It includes, like you know, cost of purchase, cost of conversion, bringing cost, and exclusions from cost. Interest subject to AS16, storage cost if incurred for finished goods, SOH and abnormal cost. So here, secondary package material required for transporting, no. Spare parts, servicing equipment and standby equipment, no. Primary packaging material which is essential to bring an item of inventory to its saleable condition. Primary packaging is important. See, publicity material is SOH, selling overhead, it is excluded. So look at this, bringing cost. Cost includes what? Other costs necessary to bring the inventory to present condition and location. Primary packaging is essential to bring an item to inventory to its saleable condition. Therefore the answer is C. C is what we will consider. Are you following, guys? Answer is always there in the material. You just have to remember the concept and go for it. Now successfully we have completed the MCQs. Out of 30, you all should target at least 25, guys. MCQs, pray to God, is a scoring area. If you are good with concepts, except you, nobody can give the marks back to the examiner. Let's go to next question. We are going to go in the same order. Application of accounting standards. They are giving some numbers. Small error in RTP, guys. This is AS2 question and it is not applicability of accounting standards. Not an issue. Let's read. Kirti Limited is in the business of manufacturing computers. We saw AC, now computers. What is the message from ICA? Work from home. During the year ended 31st March 2024, the company manufactured 550 computers. It has the policy of valuing finished goods at standard cost of 1.8 lakh per computer. Forget about what value they are valuing. We have to check if it is correct. How do you value inventory? Total cost divided by number of units. Here the number of units is given. So my number of units here is going to be 550. What is my total cost? For this, I can tell the answer, but let me quickly revise the theory since we are in AS2 itself. In AS2 itself, if you look, what all cost you will include? Cost of purchase. Here they are talking about conversion cost. This question is focusing Look at this, conversion cost. So for conversion cost, you will take all direct material and direct labor. Sir, for computer, what is direct material? The parts of computer, keyboard if any, labor to assemble that, all of that. Production overhead, variable overhead we will take based on actual production. Electricity needed for manufacturing computers, spare parts, parts of the computer. If there are 100 computers, I will need 100 mouse, all of that. Fixed overhead based on normal capacity. See, fixed overhead example is rent. Why do we take based on normal capacity? Simple logic, how many ever units you manufacture, rent is not going to change. So we take normal capacity. This is the logic. Now come here, raw materials consumed, I will take 400 as it is because it is my direct material. Direct labor 250 also I will consider. Just now we saw in the dabba, cost of conversion we will include direct labor. Then variable production overhead also you will include 150 because overhead, variable overhead is included. Fixed production overhead including interest, and in the material we saw we do not consider interest unless AS 16 asks you to capitalize. So in this 290 we will add a 290 and reduce 100. Net how much we will get, guys? You have to quickly compute 400 plus 250 plus 150 plus 290 minus 100, you get 990. Of course we can do it without calci, guys. Everyone can do this without calci, but in exam when you have that fear, you use the calci, it's okay. So now you will divide 990 divided by 550, you will get 1.8 lakhs per computer. Looks like it's Apple computer, guys, that's why it's so expensive. 1.8 lakhs per computer. So they are also getting 1.8 lakhs. We are also getting 1.8 lakhs. It is nothing but coincidence. That means standard cost method and our method also both are 1.8 lakhs. It is a coincidence. That is what ICA would have also given. Look at the answer. They got 990 by 550, which is 1.8 lakhs, and they are saying which incidentally the 1.8 lakhs which we got synchronizes with the value computed on absorption costing as under. Synchronizes means coincidence. They are trying to use fancy technical terms. If you can use them, use it, but don't use sync. No, synchronize fully if you can remember. That's it. Next question. Let's go to AS3. Okay. We will also scroll down to AS3. AS3, like you guys know, we have three types of activities: operating activities, investing activities and financing activities. Quick intro, you know operating activities are core business activities. Investing is where you invest and you get some income out of it. Financing activities is main like taking loans, paying interest, all of that. In the book itself, we would have given what are all examples of operating, examples of investing, examples of financing. Simple direct classification questions. Maybe if you are lucky, if this batch is lucky, they will ask questions like this in exam classification to save time for you also. Purse Limited, a non-financial company. Why the term non-financial is important? For a financial company, interest will become operating because bank main work is to earn interest. For a non-financial company, interest will be a financing activity because it's not their core business. They're asking you to classify loans and advance given to the following and interest earned on them. Now, what do you mean by loans given to suppliers? Let's take an example. Okay. Let's say Apple, when I say Apple, iPhone Apple, when they are purchasing, let's say some of their raw materials, like let's say glass on the phone or let's say metal body, somebody else will sell this to Apple. They don't manufacture this, correct? So to that seller, sometimes Apple might give a loan, and because they need some money for working capital or anything, and they will pay Apple some interest, correct? That is covered over there. So loans and advance given to the following and interest earned. So to my supplier, I am giving loan and that person is paying me interest. So this will be cash flow, cash inflow for me from what activities? From operating activities. Why, sir? Because supplier is part of my core business. If I can't give him the finance he needs, I might not get the goods, my operations will be affected. To employees, employees are also integral part of business. Let me give an example. When I was working in a company during COVID, the bank accounts were frozen at that time because we had money in Yes Bank. So for 6 months, bank account was frozen for everybody. So what our company said, see, you are all using Yes Bank because we asked you to use Yes Bank. So what we will do for you is for 6 months salary, we will give you as loan now itself without interest, or with interest also we will give small interest. If you want, you take it. So company is giving loan to employees not to earn income. See, you are not giving loan to suppliers and employees to earn income. It is to provide them some value or help, so employees feel connected and work well and the operations get better. So this is also cash flow from operating activities. We are in question number 4. Okay. To its subsidiary companies means holding giving loan to subsidiary. Already holding is investing in subsidiary. If you give some more money to another corporate and earn interest, this will be on what basis, guys? Investing basis, because you are giving money as a loan. Here it is an investment in subsidiary and getting interest. Investment made in subsidiary wallet and receiving dividend. If you invest in subsidiary, question itself gives the answer. This also is an investing activity. When you are solving with me, try to think of the answer before me itself. If it's wrong, it's okay. We have 20 questions. If you get even 15 correct, it's good. Dividend paid for the year is basically my source of capital in books. Is either share capital or debt. On capital you pay dividend, on debt you pay interest. Therefore interest paid on debt is financing, dividend paid on share capital also is a financing activity. This is AS3. Okay. Last one, insurance claim received by the company for loss of property, plant and equipment by fire. What is insurance claim received for loss of property, plant, equipment? Now, this one, if you look at this insurance claim over here, insurance claim received against loss of property. If you sell property, what is the entry? Bank account debit to property, plant, equipment. This is like an investment sold and realizing money. Instead of me selling, loss of property, plant. So instead of me selling and get money, property, plant, equipment got destroyed and insurance company gave money. So we will again take this as an investing activity. If we go down, okay. Okay, they have not given the answer over here. Rest are correct. Operating to employees. Here also operating to its subsidiaries investing activity. Then this also is investing activity. Dividend paid is financing. They have repeated the question, guys. Excellent. Okay, no problem. This also is, sorry, this is investing activity. Logic, sir. Logic is very simple. If you sell PPE, you get the money, it's investing. Here instead of selling, it got destroyed, so you got the money from insurance. So it is investing activity. You have invested on the risk that can happen. Next, let's go to AS4. So like this, we have all AS till 29. No, all AS questions are not given in the RTP. Some AS is omitted, like no AS 19 question, no deferred tax question. Okay. Next one, let's proceed, guys. AS4 talks about adjusting and non-adjusting events. Let me explain this, guys. Quick timeline. AS4 for the financial year, sorry, this is April, start of the year. Assume this is March, just giving you a small context. After the year ends, we have two timelines. One is when the financial statements are approved by the board of directors, and after that when the audit is completed by the auditors, and lastly when the AGM is conducted. We all know in AS4 the scope is for from the time when the financial statement year ends let me call this point A, till the time financial statements are approved by the board of directors. Only this period, what is there, we will categorize this as adjusting event or non-adjusting event. Correct? So over here if you see, what is AS4 saying? I'm giving you the timeline again guys. Follow from the time the year is ending till the time financial statements are approved by board of directors. Events that happen only in this period, this time gap between A and B is categorized as adjusting and non-adjusting. After this, AS4 not applicable, it is out of scope. It is out of scope guys. How do I categorize something as adjusting or non-adjusting? AS has given a definition, very simple. Adjusting events, events which give additional evidence of a condition or situation that existed on balance sheet date. Sir, what do you mean by this? As of balance sheet date, simple guys, something already happened. As of 31st March, something already happened. After this, after 31st March, for something that already happened, now we are getting some additional evidence. Adjusting event. Non-adjusting, new events relating to assets and liabilities after balance sheet date. That means after 31st March only this event is happening for the first time. As of 31st March, my balance sheet does not give any reason or evidence that this event has taken place. What's the accounting treatment? Adjusting event, you will adjust in the financial statements. Non-adjusting treatment, no treatment for non-adjusting. However, two things. If the non-adjusting event is material, see, it happened after board of directors approved. No, it happened during this period. It's a new event, but like earthquake came or somebody stole the stock. So during the scope of AS4, if something happens and if it is material, then you will disclose in director's report. Or if it is so material that going concern itself is affected, then it is treated like an adjusting event. You will go make the changes. Following guys, let's go to question. Look at this. For 5 companies whose financial year ends on 31st of March, so let me put the financial year on 31st of March, and the board of directors are approving it on 15th of June. 31st March, 15th June it is approved. So AS4 is talking only about this period. AS4 scope is only this period. What is happening in this period, you will call it adjusting event or non-adjusting event. What is first question in 5A? A sold major property which was included in the balance sheet. So as of 31st March, it's already included, for which contract had been exchanged on 15th March. Look at this. During the year itself, something happened for this. Sale was completed on 15th May at price of 2,50,000. After the year got over on 15th May, 15th May falls in this bracket. In this bracket, new event, no. It is an event which already took place. Now we are getting additional evidence. Look at this. The wording says events which give additional evidence. The sale of property is giving additional evidence of a situation of building that already, property that already existed. Therefore, first one is adjusting event. Second, on 30th of April, 100% subsidiary of B declared a dividend in respect of its own shares for the year ended 31st March. Now look at this. On 30th April, again it falls in our scope. Scope means what? I am talking about from financial year end till the date on which financials are approved by the board of directors. They declared dividend. But during the year up to 31st March, did you know dividend will be declared? No. It's a completely new event. Therefore, it is a non-adjusting event. That is what is there in our notes also. Look at this. Down we have proposed dividend adjustment. Proposed dividend is a non-adjusting event disclosed only in notes to accounts, so that shareholders are at least aware of this. Next, on 31st of May, mail order activities of C Limited, a retail trading group, were shut down cost amounts to 2.5 million. This is happening again when between 31st March to 15th June. This only is in AS4 scope. So this is covered in AS4. But it's a new event because 31st May the mail order directors of C Limited was shut down. It's a new event. As of 31st March I didn't know. Yes, it is a non-adjusting event. It's a non-adjusting event, but I just can't leave it like that because the cost is 2.5 million. So it is definitely material. Therefore, you will disclose in report of board of directors for a company. You will disclose in this report. If you feel it is affecting going concern, then make it adjusting. But this looks like a closure of one particular retail trading group. One part was shut down. So we will take it as material. Last two questions, guys. On 1st July, the discovery of sand under these major civil engineering contract sites cost the company increased 25,000 for which there is no corresponding recovery from customer. Super. I will give a 10 seconds gap. Can you tell me what the answer will be for this? This is happening on which day? 1st July, and our scope is 31st March to 15th June. So this is happening after board of directors approve FS. That means in our diagram, this is not happening between A to B, it's happening after B. That means AS4 itself is not applicable. Event is happening after board of directors approved. So AS4 is not applicable. So AS4 not applicable. However, expert guidance says even though AS4 not applicable, if the management wants, it is only optional, they can prepare a secondary FS. We call it a secondary FS or an additional FS and give to the shareholders like an addition information, but not in the existing FS. Okay. Now, last one, a fire on 2nd April. 2nd April means again what, guys? 2nd April means it's happening after 31st March but before 15th June. So within the scope of AS4, but fire means new event. You think if I know on 31st March, hey, 2nd April fire is going to come, let me sit and wait and watch that fire? No, it is obviously a new event. Completely destroyed a manufacturing plant, full plant is destroyed, loss of 10 million, above only 2.5 million. 10 million, 1 million is 10 lakhs, guys. 10 million means 1 crore loss, but fully covered by insurance company. Now, plant itself is destroyed, guys. So what if insurance company is giving money? Of course, non-adjusting event because it's happening on 2nd April after year ending. But if it is material, of course material, sir. What are you saying? 10 million. So you will disclose in report of board of directors. But here plant itself gone. So if the going concern itself is affected, then the non-adjusting event will become an adjusting event. It becomes an adjusting event. Detailed logic you have in marathon or other class, guys. So here we are focusing on the question and answer. Okay. With this we are done with question 4. Okay. Next going to AS5. So what does AS5 talk about? You guys know. It talks about AS5 is the biggest standard in terms of name. It has the biggest name, guys. Okay. Now in AS5, here they are discussing accounting policies. Okay. They are discussing accounting policies. I am only going to discuss that concept related to this question. So in AS5, what is an accounting policy? Accounting policy refers to specific accounting principles adopted by the enterprise in the preparation and presentation of financial statements. Sir, I didn't understand. No problem. I know you didn't understand. Trading and P&L, closing stock valuation has to happen every year. So, valuation of closing stock is an accounting principle which you do every year. How to value closing stock? You either use FIFO or weighted average. So weighted average or FIFO is the method used to apply the accounting principle of valuation of closing stock. Therefore, these methods FIFO or weighted average are known as accounting policies. So, accounting policies are used in accounting principles, applying accounting principles in the preparation of financial statements. So, you know now what is accounting policy. The standard AS5, AS1 talks about what is accounting policy, guys. AS5 says what is not a change in accounting policy. It says, the adoption of a new accounting policy for events or transactions which did not occur previously or that were immaterial. I am introducing something for the first time. For example, in my office, employees will sleep here only. Sir, what are you saying, sir? I won't let them go home. Now I am saying, okay, from now, yearly once for you vacation. What is the vacation? Go home and come. Joking, guys, but yearly once for you vacation, go for Goa and come 5 days. I am introducing a new policy which was not there before itself. So, adoption of a new accounting policy is not a change in accounting policy, it is introduction of accounting policy. Same way, adoption of an accounting policy for events or transactions that differ in substance from previously occurring events or transactions. Complete transformation. Sir, what do you mean, sir? Attendance for employees before biometric. Now I am doing ID card because of COVID. But now what they are saying, adoption of an accounting policy for events or transactions that differ in substance from previously occurring events or transactions. Now I am saying no attendance. If you are part of my company, you will get full payment even if you took 1 month leave. But for that you should get leave. So I am removing the tracking of attendance itself, completely changing, differs in substance itself than what it was before. Sir, what do you mean, sir? Chicken biryani, I can make in Hyderabadi style or Dindigal style or Kerala style. Same chicken biryani you can do in different way, different accounting policies. Through the chicken biryani, I am making veg pulao. Same food only, complete change. From non-veg I became veg, sir. So, complete change in substance is not a change in accounting policy, it is changing accounting principle itself fully. So, now you read here whether this will be constituting a change in accounting policy or not. I gave you theory background. Now, introduction of a formal gratuity retirement plan by employer in place of an ad hoc gratuity plan. So, before I used to give randomly, now I am introducing a plan. Look at this. Here, I am adoption of a new accounting policy is not a change. This is something that is completely new. Second, management decided to pay pension to those employees who retired after 5 years. So, if you complete 5 years, I am giving you pension. Such employees will get pension of 20,000 per month. Earlier, there was no such scheme. So, look at this. This also is not a change in accounting policy because here a new policy is introduced. Here, existing policy is changing in whole substance. Look at this. In whole substance you are changing. So, differ in substance. If the whole thing is differing in substance, then this point is covered over here. Look at this, guys. Bringing a formal plan instead of paying ad hoc. Ad hoc means randomly giving, now formal plan. In second one, completely new policy is introduced. Look at the RTP answer for question number 6, same thing. Introduction of a formal plan, adoption of a new accounting policy that does not occur will not be treated as an accounting change in accounting policy. Look at this wordings. The adoption of an accounting policy for events that differ in substance will not be considered as a change in accounting policy. So, this is differ in substance, this is introduction of a new thing. Same our note, 2 points we have covered. I hope you guys are following, understanding, guys, still here. Sorry, apologies for the cough. Okay. Now, Before I go to 7th question, let me do 8th question, AS9. Sir, after AS7, why AS9 came? Sir, AS8 is not there. It's not there in syllabus itself, okay? It's removed from standard itself. We don't have an AS8. When will the revenue be recognized in case of interdivisional transfers? What do you mean by interdivisional transfers? Department A is selling to Department B for rupees 200 rupees. Will you consider this? The answer is no. This is not revenue as per AS9 because of two things. One, risk and rewards are not transferred from A to B. Revenue means when you are selling something, risk and reward should be transferred. At the same time, you should also receive consideration. What is AS9? Revenue means gross inflow of cash, receivables, other consideration. We are not receiving consideration because only when Department B sells to the end customer, risk and rewards are transferred and we receive consideration. From Department A to Department B, if you shift, risk and rewards are still with the same company. What do you mean, sir? In Department B, if the goods get damaged, who will bear the loss? Same entity, same company, and I am not getting consideration from third party. Therefore, answer for question 8 is no, not applicable to AS9. AS9 does not consider interdivisional transfer as sales. That's why for this you have a separate standard, AS17, segment reporting to an extent. Okay. Now let's do question number 7, AS7. Beautiful question. New study mat, they have added similar questions, 2 to 3 questions they have added in the new study mat. Okay. Construction contract. Here they are discussing two things. How do you recognize revenue in construction contract? We use a method called cost to cost method. Basically, cost incurred till date divided by total cost of project. So, how sums are done in AS7? Follow guys, let me give a simple example before we go for this sum, which is a proper classic exam sum for 7 marks, which even came in May 24 exam. AS7 came, but not this particular sum. Construction contracts, what happens? It goes for multiple years, year 1, year 2, year 3. So, how do we recognize revenue? We have simple steps guys. Step 1, they tell us compute percentage of completion. What is percentage of completion? Cost till date by overall cost of contract. For example, let's say here the overall contract for 3 years is 1000 crores. Okay. Now they are saying cost till date in each of these years. First year they are saying cost is 300. Second year they are saying cost is 400, and third year again they are saying cost is 300. So totally all the 3 years put together again 1000 is coming. So we will just reduce the cost little bit so that there will be profit guys. Let me make 300, 200, 400 in the last year. So total cost will be 300 plus 200 plus 400, 700, 900 is going to be my total cost. First year if you see, my cost is 300 divided by total cost is 900 into 100. If you do, you will get 300 divided by 900 percentage. So if I get 300 divided by 900 percentage, you will get 33.33% of the work is done. So what they are saying in step 2, revenue of each year is equal to total revenue into percentage completed in that year. So here in the first year, out of 1000, 33% is completed, 33.33. So 333 will be my revenue I recognize in that year. This logic comes from AS9, percentage of completion, which is nothing but accrual. Sir, this year I did 33% work, so I deserve to recognize 33% revenue. Next year I am doing 40% work, I will recognize 40% in that year. So this year net profit is 33. Next year if you see, they have done 200, but already in year 1 they completed 300. So if you look at next year, overall cost is 900, first year already 300 is completed, and second year I am adding another 200. So 300 plus 200 into 100, this time you will get 500 divided by 900 percentage. In second year 55.55% of work is completed. So in second year if you see 1000 into 55.55 percentage, 555 of revenue is cumulatively to be recognized in year 1 plus year 2, because year 1 plus year 2 you have finished 55 percentage overall. Out of this 555, already 330 is recognized in year 1 now. So year 2 I will do 555 minus 333, I will recognize 222 in second year. Or in other words, sir, in simple, second year 55% is done. In that first year already 33.33% work is completed. So second year what is additional work? 22.22 percentage is the new work in year 2. So second year revenue I will recognize as 222. My net profit is 22. Last year 100% work over, because last year if you see percentage of completion, 300 of first year, 200 of second year, and last year 400 we put, plus 400 by 900 will be 100% of work. So full 100% of revenue I can recognize. I will recognize full 1000, but already first year 333 I recognized, second year 555 I recognized. Therefore I will do 1000 minus 333 minus 222. Second year I recognize 222 minus 222, you will get 445. Therefore 45 is the net profit I will recognize, guys. I will explain in the end. So overall net profit is going to be 33 plus 22 plus 45, which will be 100. 100 is nothing but contract revenue 1000 minus contract cost 900. Sir, what is this, sir? This is not any question. I am explaining the concept of the whole standard with a 5 minutes illustration, guys. Follow. When your contract revenue is 1000 crores spread over from year 1 to year 3, and the contract cost is 900 spread over in the 3 years as 300, 200 and 400, how should you recognize revenue? The steps are as follows. First, you have to find out percentage completed in each year and account revenue in that year for that percentage of revenue and find net profit. Year 2, you will again do the same thing. Find that year's revenue for that year's work, reduce that year's cost and find that year's profit. Are you getting it, guys? Meaning, if you studied in 1 month only 10% of syllabus, only 10% of knowledge you will get. If you studied in 1 month 40% of syllabus, 40% of CA inter knowledge you will get. Like that they are saying, even though 100% syllabus is there, 100% revenue is there, 100% cost is there. Each year, what they are saying for each year, recognize revenue that belongs to that year, compare with cost of that year, actual cost of that year to find net profit of that year. That is what we are doing over here. Now look at the sum. Coming to the actual sum, guys. In the actual sum, if you see, Meha Limited has undertaken a bridge construction wherein bridge will be constructed in 3 years. Revenue is 900, cost is 800. Super. So for 3 years I have to split I know profit is 100 crores, guys, for all the 3 years. But I have to split this for each of the 3 years. How will I do? In year 1, estimated contract cost is 805, cost incurred up to that date is 161. Similarly, year 2, increase in contract revenue by 20. That means already 900 was revenue, now increase by 20. It is going to become 920 in year 2. And first year I thought cost is 805. Second year cost also is increasing by 15. So second year cost will become 820. How sir 820? 805 first year's cost plus 15 of second year's cost, 820. And they are saying second year you incurred cost of 584 cumulatively, and third year 820 full cost is incurred. So you started off with 900 and 800, end of year 3 900 became 920, 800 became 820. So 900 became 915 guys. Yeah. End of third year 900 plus 15. It becomes 915 and cost becomes 800 plus 20, 820. Are you following guys? I will explain with the solution. At the end of year 2, after year 2 is over, cost incurred. What is the cost incurred? 584. This 584 includes 10 crores for material purchased or stored at the site to be used in year 3 to complete the contract. So what they are saying, this 584 of year 2, I incurred only out of 584 minus 10, you incurred only 5. 74 I incurred this year, 10 is the closing stock of this year, I am using for the next year. I hope you got it guys. Out of 584, 10 I am going to spend in next year. Therefore, what is the actual cost? 574. It's like saying you got 2 chocolates with you, you ate only 1 chocolate. How many chocolates you have left? 1. What you actually ate is 1. You can't tell you ate 2 when you ate only 1. Same way here, 584 is the total cost I spent, but I did not use 10. So I did not eat this 10. What you actually ate or what you actually spent is 574. Fine. Let's go and solve this with the solution itself so that it becomes easy for us. Okay, that's how I study, especially 1 week before exam, since similar sum is there in study mat itself. Okay, now not the similar sum, exactly same sum we have, just the change of numbers, and even more advanced sum is there in study mat. When the new sum comes, I will tell you guys what are the new sums. Look at this. Look at the solution. Initially the revenue planned was 900, total contract value. First year cost incurred is 161, it's there in the question. So what is percentage of completion of first year? 161 divided by total cost in first year is 805, it's there in the question. Look at this guys. 161 is the cost of that year, 805 is the total cost. So percentage of completion is 161 by 805 into 100, you will get 20%. That means when I prepare the first year P&L, follow guys, 900 into 20% will be my revenue of year 1. I am replicating this example what I did here with difference in numbers. So out of overall revenue, 20% I will recognize here, which is 180, out of which cost is 161 in the first year. How sir 161? Question has given first year cost is 161. Therefore, my net profit is 19 for the first year. Come down 180, 161, 19. That is the profit for the first year. Sir, what about second year? Let me prepare second year. Second year, if you see, the question says 584 is the total contract cost that has been incurred. But out of this 584, when I am doing percentage for second year, I told you 584 you should reduce 10 because 10 is not there. So 574 only I will take, divided by total cost is how much? It is not 805 guys, because cost has increased to 820. So 574 divided by 820 into 100, you will get, look at this, 574 by 820 into 100, you will get 70%. So second year I will recognize 900 into 70%. So what is 900 into 70%? Without calci also you will get 630. But out of this 630, already you recognized 180 previous year. Therefore, what is the additional revenue this year? 630 minus 180. After minusing 180, you will get 450 is the revenue. Only year 2 revenue is 450. What is the only cost of year 2? Look at this. For second year, they are doing it on a cumulative basis, guys. We will do it without cumulative basis. 644, 1 second. Year 2 percentage is 70%. Yes, we got 70%, 574 by 820. So year 2 revenue, we also got, okay, we made the one small mistake. What we should not be doing, look at this. While explaining the question, what did I tell you? Year 1 revenue is 900, but year 2 revenue we added 20. So year 2 revenue became 920. We took it that time. So here also we made a small mistake. We will not take 900 over here, guys. We should not take 900 because revenue increased from 900 to 920. I am not trying to show what mistakes you will do in exam. This is a mistake which I have done. That means this is a common mistake that can happen. So year 2 you will take 920 into 70%. So 920 into 70% will give me 644. That's what came here. Look at this. 644 as the revenue overall of year 2. But out of 644, 180 is already recognized. Therefore, what is the additional revenue? 464 is the additional revenue. Look at this. Additional revenue is 464. And then my overall cost is how much? 574. But in that you already recognized 161 in the previous year. So what is the new cost of this year? 574 minus 161, which is 413. That means, to summarize this, second year only, my revenue only for year 2, only year 2 revenue is 465, only year 2 cost is 413. So 464 minus 413 gives you a profit of 51. That's what you will find here, 51. 464 minus 413. Now coming to third year, guys, coming to third year, guys, what happens in third year? Percentage of work done will become 100 because 820 by 820. Question also says third year it is 820. So full 820 is done. So in third year you will recognize the full revenue. What is the full revenue in third year? 920. Recognize full cost, which is, how much is it, guys? Yeah, third year full cost also becomes 820. So full cost, full revenue, but already how much you recognized last year? Minus 644 until year 2, 644 until year 2 and 574 until year 2. So you will do 820 minus 574. So here you will get, so year 3 exclusive year 3 revenue. See, year 3 920 minus 820 gives you 100 as the revenue. This is overall revenue. But what is only revenue of year 3? 920 minus 644 gives me 276 is the only revenue of year 3. And this side you will get, what, guys? Look at this. 820 minus 574, you will get 246 as the cost of year 3. So 246 minus 276, you will get 30 as the revenue of year 3. That's what you will get here, 30 as the revenue of year 3. So if you add all the things, 19 plus 51 plus 30, revenue of each year, 19 plus 51 plus 30, you will end up with 100, which is split for all these 3 years. I hope you guys are able to follow, guys. I am using the answer but also doing computation for you to understand. If you are not understanding, let me know in the comments. If most of you feel that way, you can check the marathon for detailed explanation, or we will again discuss this separately for you if everybody feels you have not understood this. We have also now finished question 7, question 8. Now let's go to question 9, which talks about AS 11. Sorry guys, please ignore that. Very sorry about that, little bit down with cough, but yeah. Let's come back to next concept, AS11. What question they are testing? I am giving you introduction just for that concept. So if I go to our notes, they haven't, AS9 they asked MCQ, they haven't asked any question majorly from AS10 in the RTP, so I am skipping AS10 questions. In AS11 like you all know talks about many concepts. Here they are testing one concept which most of you might already be aware. It talks about when there is a long term foreign currency borrowing for the purpose of a depreciable asset, the exchange loss or gain can be charged to P&L or adjusted with the cost of the asset. This concept is being tested. Let me explain this once before we go to the sum. Imagine you purchased one asset by taking a loan of $10 lakh guys, not 10 lakh rupees, $10 lakh. This loan was used to buy an asset. It was used to buy an asset. Now, let's say when you took the loan was 60 or let's say loan was 80 rupees per dollar. But because the dollar keeps growing, it keeps getting bigger because US is one of the most powerful countries in the world, demand for dollar is high. Everybody wants dollars. So let's say after 1 year, this $80 became 85. That means just look at the amount you have to pay extra, only the extra amount. Don't look at the interest and all. $10 lakh, okay, into ₹5 rupees in 1 year, 50 lakhs in terms of INR is the extra amount you have to pay in just 1 year as an expense, not because of wrong not because of wrong operation, but because of movement in forex. Now what will happen in my P&L account? If you see this 50 lakhs, if I debit here 50 lakhs, my net profit will fall by 50 lakhs and people will think company has not performed well, where in fact what has not performed well is not the company but the dollar movement has not performed in our favor, correct? So for this, what AS11 says, they give two options. Okay, I understand this is a loss, therefore if you have a lot of profits, go ahead and charge to P&L and debit to P&L. However, if you don't have so many profits, you add it to the cost of the asset, whatever is the forex loss, interest plus principal, you add it to the cost of asset. Then what happens? You are not going to debit in the P&L. This 50 lakhs will be added to cost of asset, and then this asset will be depreciated, let's say for the next 10 years. Therefore, depreciation per year is 5 lakhs. So instead of debiting 5 lakhs, instead of debiting 50 lakhs, instead of debiting 50 lakhs to the P&L, they are only going to debit 5 lakhs. So instead of debiting 50 lakhs, how much are we going to debit guys? 5 lakhs. So the impact on net profit is reduced. That is the option given where there is a long term foreign currency borrowing, and on such borrowing which is used for a depreciable asset, amortize the loss over the life of the asset by adding that loss to the cost of the asset. I am again repeating guys, the conclusion is what? The loss on forex can be added to cost of asset, therefore this will be amortized over the life of the asset along with depreciation. With this background, let's do question number 9. AS11. Alpha Limited purchased an item of PPE for US 50 lakh rupees, no dollars, on 1st April 2023. The same was fully financed by the foreign currency loan, repayment in 5 equal installments annually. So $50 is going to be repaid, $50 lakh, but I am just ignoring that lakh guys, is going to be repaid as $10 lakh in each of the years. So 10 lakh plus 10 lakh plus 10 lakh plus 10 lakh plus 10. So 5 times I will pay. Exchange rate at the time of purchase was 60. Maybe when they made the question it was 60. After 1 year, so look at this. On 1st April 23, it was 60. On 31st March 24, it became 62. It increased by 2 rupees. The entire loss on forex was included in the cost of goods sold. Alpha normally provides depreciation on item of property, plant, equipment at 20% on WDV basis and exercise the option to adjust the cost of asset for the foreign exchange loss arising out of loan restatement and payment. Basically, what should I calculate? They are asking you to calculate amount of exchange loss and treatment of depreciation. So, first you find the loss, guys. Very simple. $50 lakh into, instead of 60, it has become 62. So, into 62 minus 60, $50 lakh into 2, it will become 100. It's going to become 100 lakh, guys. Look at this. It's going to become 100 lakh extra you are going to repay. But in this, already first installment is paid up. First installment is already paid, guys. Therefore, what I will do, out of 50 lakhs, remaining loan is only $40 lakh. So, this will be repaid later. So, loan is now going to increase by $80 lakh. And apart from this, additionally, $20 lakh already is paid. Sir, I am not able to understand. Very simple, guys. $50 lakh are there. In this, I will split into two. $10 lakh already paid. $40 lakh will be paid in the future. For me, both is loss because this is already debited to P&L. This is going to be my increase in liability. So, for this it is going to be 40 into 62 minus 60, which is going to be in dollars 80 lakhs. This side is going to be 10 lakh into 62 minus 60, which is 20 lakhs. So, effectively, what is the extra I am paying, guys? 20 lakh plus 80 lakh, which is 100 lakh is going to be the extra I am going to pay. This I will add it to the cost of PPE. What is the cost of PPE in the question that they have given? When I purchased the 50 lakhs, it was 60, correct? So, that time when I purchased, it was 50 lakh into rupees 60, which will give me 3,000 lakhs, sorry. For this, now I will add this 100, it will become 3,100 lakhs, which is the revised, correct? 3,000, yeah, 50 lakhs into 60 is 3,000. Revised is going to be 3,100 value PPE. On this, I will provide 20% depreciation. Are you following, guys? Let's cross check this answer with the material. Same answer is there here. Look at this. Totally foreign currency loan is 3,000 lakhs. Additional payment is 80 lakhs and 20 lakhs. 20 lakhs is future. Sorry, 80 lakhs is future. 20 lakhs is already paid. So, total is 100, which is 80 plus 20. Therefore, they are saying total increase is 3,000 plus 100. Same thing we got. 3,000 plus 100, 3,100 into 20%. So, 3,100 into 20%, you will get over here 620 lakhs of depreciation I will charge to my books. That only they are charging here also, guys. Look at this. 620 lakhs is charged as depreciation. I hope you guys are able to understand the concept and the sum. Okay. Of course, we are going speed fast, guys. I told you all. You are going to read the chapter, learn everything, watch some marathon, and then come and solve these sums. So, within 1.5 to 2 hours, RTP is done for you. Like one movie, interval time, RTP is over. If you're feeling bored or sleepy, guys, those who are watching online, keep repeating with me, or the best thing is pause this video, go sleep, and exam also sleep. That's not what I'm saying. If you're feeling bored, actually just push yourself, get some popcorn and think this is a movie. We can't do anything beyond that, guys. Exam is very close. AS12. Next. Energy Limited has acquired a generator on 1st April 2023 for 100 lakhs. On 2nd April 2023, look at this. Just 1 day after that, it applied to IRED for a subsidy. Some government department I applied for subsidy. The subsidy was granted in June 2024. So if I prepare a timeline here, if I prepare a simple timeline, these are all new questions, guys, not there in our study mat, new to new syllabus itself. So 1st April 23, okay, year ends on 31st March 24, and after the year in June 2024 only they applied, no, they applied on 1st April 2023, look at this, this date they applied and they got the grant in June 2024, next year in June. The subsidy was granted in June 2024 after the accounts for the 23-24 was finalized. That means after board finalized we got it. The company has not accounted for subsidy in the year 31st March 2024. They are saying in this period, guys, this financial year, 1st April 2023 to 31st March 2024, they have not accounted the grant because it came only in June 2024. Next year, after the board approved only it came. Is this a prior period item? What is AS5 saying? Prior period items are those items, I will repeat, prior period items are those items that you account in the current year as a result of error or omission in accounting in any of the previous financial years. I am repeating, because of some error or omission in the previous year, if you are accounting something in this year only, you will call prior period item. Here in the year 23-24, they did not account for grant because it was not certain you will receive it. Therefore, company did not make any mistake by not accounting in the previous year. They did not do any omission, they did not do any error. Therefore, this is not a prior period item. How should the subsidy be accounted in the year 24-25? Quickly we will check here. Look at this. Same answer, AS12. Therefore, the company was right in recognizing the grant. This is not a prior period item. Same explanation. The subsidy should be deducted from the cost of generator. Of course, how should they account this? Already you purchased for 100 lakhs. Here they are testing AS12. If you already noticed by now, sometimes they are testing AS4 with AS9, they are testing AS5 with AS12. That means what is ICA trying to tell you, guys? Don't skip any standard. Sir, I studied AS5, I skipped AS12. You can't answer this because they are syncing. Why are they syncing like this? Do you think after you go to articleship, client will have a problem? You will think only in the angle of AS12 or AS5. You should know everything and apply your knowledge. That is what they are trying to test. So, what is the amount of grant they received? Whatever grant is received, from the cost of 100 lakhs, you have to reduce the grant. Let's say grant is 30 lakhs. So, balance 70 lakhs, you will carry forward the asset and you will charge depreciation. So, this is what we will do. That is what is given over here. The subsidy should be deducted from the cost of generator. Revised unamortized amount should be written off over the useful life, or AS12 also gives a concept called deferred income accounting. Instead of reducing from the cost, we will defer it over the life of the asset. Perfect. Let's go to the next question, guys. Yeah. So let me read the question. The question is pretty big, answer is small. Okay. Yeah. Next question. A company is engaged in the business of refining, transportation and marketing of petroleum products. Okay, thank you. During the financial year ended 31st March, they are discussing AS 13, classification of investments as current investments versus non-current investments. Let's see what they are testing. The company acquired controlling interest, that means holding. They became holding company from Government of India, and in another public sector undertaking at rupees 1551 per share against the book value of 192 rupees and market price was 876 on 18th Feb 2024. So what is basically happening, guys? Some companies, petroleum company whose book value, balance sheet book value was only 192, something 192.58, in the market, which market? In the stock exchange, the price is 876, but I paid 1551. Dhoni's cricket bat in the shop is 10,000 rupees, but because Dhoni signed, you will buy for 1 lakh. Like that, this company's market price is only 876, but you paid 1551 to buy it at a premium. Thus, strategic premium 675, which is 1551 minus 876, considering various tangible and intangible benefits. Okay. The above investment in shares of the acquired company has been considered as a long-term strategic investment. Yes, okay. He itself is saying long-term, therefore you will take it as a non-current investment more than 12 months, and therefore has been accounted at cost. Yes, AS 13 tells me non-current investment will be accounted at cost price at 1551 in the financial statements. No provision in diminution in value has been made in books of accounts. Okay. Next, as per the requirements of Schedule 3, the aggregate market value of the quoted shares has been properly reflected in the financial statements. They are saying disclosure is done. Fine. What is happening next? On 28th March 2024, the acquired shares were quoted at 880 per share. So, this 876 became 880, and the current market price on 18th July, little later, this is March, look at this. I purchased in which month? I purchased in Feb. So, in Feb it was 876, then in March it became 880, then in July it again came down to 300, crash. Considering the tangible and intangible benefits, the management is of the view that there is no permanent diminution in the value of strategic investment. The same has been considered still as long-term investment. There is no need to provide for any provision. Now, quick revision of concept before we go discuss the question. Look at this. For exam, in our notes, what is relevant, guys? Investments are classified into current investments and long-term investments. Current investment will always be up to next 12 months. What you want to sell within next 12 months, you will value them at cost or fair value. I am not discussing this concept, I am discussing long-term investments. So, these are usually carried at cost. Whatever happens to market price, goes up or comes down, I ignore because my intention is long-term. When your intention is long-term goals in life, small setbacks you should ignore, guys. You should ignore. That is the logic behind this. There is a life logic in AS 13 long-term investment. I will again repeat this life logic, guys. When your goal is long-term in life, I have something planned 10 years, 15 years. Small setbacks, small failures, you should just overcome and focus on the long thing. Otherwise, small setbacks and failures, if you take it to your head, then your long term goal will be affected. That same concept is saying, always value at cost. Even if the market price falls below, ignore it. Decline in value of investment which is not temporary. He is saying only if the decline or fall is permanent, then you will write off. Carrying amount of investment, all of that should happen. Are you following, guys? So only permanent fall you should write off, otherwise you should not write. But the wordings used in the standard, they do not use the word permanent, because permanent means it is permanent, cannot be reversed. So the wordings they use is other than temporary, So look at this. Whether accounting treatment at cost under long term investment without providing for diminution in the value is correct, answer is yes. Why, sir? Yes, because the fall is not permanent, or it's not other than, only when it's other than temporary. When the fall is permanent, you will write off. Here it is temporary fall, so we will ignore it. If any provision for diminution in the value is to be made, whether such provision should be charged to the P&L account or whether the same can be considered as deferred expenditure and amortized over 5 years. Whether it is open for the company to charge off diminution in the value of books instead of creating a provision. We don't have a concept like writing off the loss over 5 years in AS 13. Answer is no. You also can't charge it to the P&L, you will hit it to the reserves. Such fall will straight away go to reserves, guys. Therefore, you cannot amortize over 5 years also. Last, whether the premium paid for strategic benefit for investment described in the facts of the case can be accounted for separately, keeping in view of the AS 13. What is trying to say? Sir, price is only 876, you paid 1551, so extra premium you paid is 675. So investments, when I debit, instead of debiting 1551, can I classify as 2? How much is cost? How much is premium? I paid extra 675. Can I show premium separately in investment? See, let's say you wanted to buy a house in Chennai, beach house, ECR. You wanted to buy a house next to Vijay's house. So you can tell hi to him every day. Now the house is going to cost you minimum 10 crores, or 10 crores is too less, guys. That area is very high square feet. So let's say 50 crores you are going to pay. So something which is 10 crores, you chose to pay 50 crores, you paid premium, for you that is cost. See, it is 50 crores, it is a premium, but that is cost for you. So what is cost for you? 50 crores. What is cost for the company here? 1551. So I will account fully as a cost. It's still a cost for me. You paid from pocket. So no treatment of premium separately. Fully will be shown only at cost. This is the answer for this particular question. Okay. We will come back to AS 16 in a bit, guys. This is a new question added in the RTP. If you ask me, in this entire RTP, which is the most challenging question, or not challenging, which is the most lengthy question, I will pick this question only. So we will do this in some time. Let me just do few other questions and then come back to this. AS 17, whether interest expense relating to overdraft and other operating liabilities identified to a particular segment should be included to segment expense or not. Let's quickly go to our AS 17 notes. Yeah, in AS 17, I would have given what we will include in the particular segment revenue, segment assets, segment liabilities and segment expense. Because we are classifying based on each segments for the report, it includes, since this question is about segment expense, it includes expense incurred through external transaction. Let's say take ITC as a company, one of their segment is stationery, classmate notebook, maybe the notebook you are using now also is classmate. So when I prepare the stationery segment, it includes expense incurred through external transactions, stationery, purchased paper from outside or purchased some colors from outside. Expense incurred through internal transaction, stationery department purchased, let's say, some food from the FMCG department, or from the paint department they purchased some color. Internal purchase expense included. Common expense allocated on a reasonable basis. Same ITC office, director is sitting, director of the company, I will allocate on a reasonable basis based on his time worked. What is excluded? Extraordinary item as per AS 5 is excluded. Interest is excluded unless it is of an operating nature for a bank. Therefore, in this question, interest answer is no. We will not include it. We will not be including it, guys. Okay. Now, we just have few more questions, guys. That's it. We will be done with the RTP. Let me take up now AS 23 and then I will come back to the two questions in AS 16 and AS 20. Okay. AS 23 is part of consolidation. Yes, when I started I said consolidation is not there. I meant the big consolidation sum, 14 mark question. This is consolidation of associate. Let us know what is an associate definition. You all know, where one entity has significant influence in another entity. When one entity has a significant influence in another entity, then entity A is said to be an associate of entity B. So, entity A is called the investing party. For entity A, entity B is the associate. Okay. So, investing party is investing in associate. Sir, what do you mean by significant influence? Significant influence means ability to have at least 20% of the voting power. So, if you have at least 20% or more of the voting power in another company, then the associate relationship is made. This also says sometimes the test, even if you have more than 20%, but if you do not have significant influence, you do not have the influence, then you are not an associate. Sometimes even if you have less than 20%, I have only 7%, I have only 1%, but I can influence. For example, Dhoni in CSK might not have 20% shares of CSK, maybe 1, 2, 5, 10% shares of CSK, but he has the ability to influence CSK's decisions. So, even though he has less than 20%, he will be considered as an associate. This is exception. So, what is the general rule, sir? Simple. Do you have 20% or more? Answer is yes. Then you have then you are an associate. Answer is no. Then you are not an associate. However, both of this has an exception. Even if you have more than 20%, you are not an associate if you do not have significant influence, if you do not have influence. Even if you have less than 20%, if you have just 2 or 3%, if you are able to influence, then you have significant influence. Are you guys following? Okay. How to count this 20%? In AS 23, it says you will consider voting power, and here you will consider only present voting power and not the future voting power. We will take only present voting power. So, look at this. Hill Limited has 50,000 shares at rupees 100 per share. Sun Limited acquired 15% shares in Hill Limited on 1st April. It also acquired all the 5,000 convertible debentures of Hill Limited. These debentures will be converted into equity shares after 3 years. So, totally how much I have? I have today 15%. In future, you will get 12% of debentures. So, totally you will have 27%. I have now more than 20%. Therefore, am I an associate? As per percentage, yes. But the standard says don't consider future equity, consider only present equity. So I will not consider 12%, I will take only 15%, therefore it is less than 20%. This is not an associate. This is not an associate because you do not consider future equity shares. We take only present equity shares. What is the power? Now, are you following, guys? With this, AS 23 also is done, guys. So what all questions we have left? 1 to 11 everything is done. 12th question is pending, and then AS 20, and then just few more questions, and then we will be done, guys. We will be done. Okay. So we will start off with this AS 16 new question which is added for us. I hope till here all of you are able to understand, guys. If you have stayed till here, stay for some more time, 30-40 minutes. By the time we complete this RTP, and with us together you would have finished studying this. So let's proceed. Okay. So hi guys, we will now continue with question number 12 in AS 16. Like I had mentioned, this is a new question added in the RTP. We don't have traces of this in any of our previous materials. Loyal Limited has undertaken a project for expansion of capacity as per the following details. Look at this. From October 2023 till March 2024, the last 6 months, they wanted to do some plan, and actually they have spent so much money. Since the question is hinting us it's AS 16, should I take the planned budget or actual spending? Ignore this column. You will only take what is actually spent. Remember guys, AS 16 talks about borrowing cost. What is borrowing cost all about? If you see AS 16, if we go to our notes, quickly just a 1 minute revision. What is AS 16 saying? Borrowing cost is the like interest. Borrowing cost incurred on a qualifying asset will be capitalized, as simple as that. So what's the standard saying? Hey, have you incurred borrowing cost? Yes. Have you incurred this on a qualifying asset? Yes. Then you will go ahead and capitalize if it meets some conditions that is given over there. So here they are not testing all of that. Straight away they are saying it's a project. Actually what is spent only we will take, because one of the conditions says for borrowing cost, one of the conditions, general conditions of capitalization and specific conditions, if you see, cost should be reliably measured. Under that specific conditions, borrowing cost should be incurred, expenditure should be incurred, there should be activity on the qualifying asset. This question is targeting these 3 points only. Borrowing cost to be incurred, expenditure to be incurred, there should be activity on the qualifying asset. Now if you see, this month, this money has been spent, come down, the company pays interest at rate of 15% to the bank, which is debited on a monthly basis. So monthly I will pay interest, computation of interest also is on a monthly basis. During the half year from October to March, which is 6 months, company had 20 lakhs overdraft up to 31st December. So up to 31st of December, they had the ability to borrow up to 20 lakhs. Surplus cash in Jan. That means in the month of Jan, we did not have OD. OD is repaid. So month of Jan, OD is repaid means no need to pay interest in the month of Jan. And again, overdraft of 14 lakhs from 1st Feb. So first few months I had limit up to 20 lakhs guys. I can borrow up to 20 lakhs. After that Jan month OD became 0. I repaid everything. Again in the month of Feb, new OD limit is 14 lakhs is the new limit of OD from 1st Feb itself. And 30 lakhs from 1st of March. Again March they have increased last month because the usage is more, limit is increased. The company had a strike during December. We know suspension of borrowing cost concept, avoidable suspension, unavoidable suspension. If it is avoidable suspension, then borrowing cost should not be capitalized in that period. Unavoidable suspension, borrowing cost can be capitalized. We have that in notes. See, avoidable suspension. For example, like here, strike is an avoidable suspension. So, borrowing cost should not be capitalized. Unavoidable suspension, borrowing cost should be capitalized like flood, etc. So, in this question, the company had a strike during December. So, you should not capitalize, but however, and hence could not continue the work during the said period. However, the substantial administrative work regarding the project had continued. So, since admin work, some activity was going on. Just now we saw there should be activity on the qualifying asset. It can be physical, technical or administrative. So, because administrative activity is there, no need to suspend borrowing cost, you can continue. On-site work was again commenced on 1st Jan. After December there was a halt, but it does not matter here because admin activity was going on and all the work was completed on 31st of March. Assume that the expense was incurred on 1st of every month. Calculate how much should be capitalized. Let me explain this with the solution so that we will save time. But once you understand the sum, after 1-2 days, please put the pen on paper and you have to solve it, guys. I finished CA. I don't have to solve. My work is to tell you how to do it. If you understand and you actually have to do it. Look at this. 1st October 2023. What is the expense in October 2023? They have given the expenses 4 lakhs, correct? Expenses 4 lakhs. So, in this 4 lakhs, sorry. Yeah, just a second. Yeah, so expenses 4 lakhs. In this 4 lakhs, if you see here, interest is computed 4 lakhs into 15% into 1/12 for 1 month. So, first month interest is 5,000. Outstanding amount is still not yet paid is 4 lakhs plus 5,000. 4 lakh 5,000 is payable in the first month. Cumulatively also 4 lakh 5,000. Sir, what about the second month? Second month, if you see here, 7 lakh 95,000 has been borrowed additionally. So, second month in November 2023, 7 lakh 95,000, but this time you have to pay interest for full outstanding. So, already 4 lakhs is outstanding plus 7 lakh 95,000, add both of this into 15% into 1/12. Because this time I have to pay interest for October loan and November loan. That's why they have added both, applied 15% into 1/12. So, the interest will come to 15,000 which is capitalized. Now, what is the total amount of loan I have to repay, guys? Principal plus interest fully has to be repaid. How much is this full principal plus interest? 4 lakh 5,000 previous outstanding plus new 7 lakh 95 plus 15,000, 12 lakh 15,000 has to be repaid. We are yet to repay this. So, if you don't repay within 1 month, see, they told interest is debited on a monthly basis. So, if you don't repay within the same month, on interest, they will charge interest. That is what is happening here. Look at this. Second case over here. Second case, what they have done, 4 lakhs plus 795 plus that 4,000, 5,000 interest also is taken. Look at this, 4 lakh 5,000 and 7 lakh 95. So, on this 5,000 interest, again they are charging interest because you have not paid. It is interest on interest. Next, let's go to the month of December. In December, no expense has been taken. Even though work has been suspended, we can continue capitalization. So, interest I will pay the same outstanding. Look at this, 12 lakh 15 will continue into 15%. So, 12 lakh 15 you are still yet to repay in December into 15% into 1/12. You will get 15,188. Now, cumulatively, since the start October, November, December, total principal plus total interest. Look at this, 12 lakh 15,800 previous thing plus 15,188. You will get 12 lakh 30,188. Now, the question says, In January, company had surplus cash. That means this full 12,30,000, full 12,30,000 in January, it is repaid. It is repaid freshly. We have surplus they have taken. So not repaid exactly. OD is not used that time. So if there is surplus cash, OD is not used. How does OD work, guys? In overdraft, if my overdraft limit is 2 lakhs, if I use 2 lakhs, I will be charged interest. If I don't use, then there is no interest. It's like a credit card. If you use, there will be charges. So here if you see, in the month of January, they told again you started spending 50,000, but this 50,000 if you see, guys, there is absolutely no interest, because for this 50,000 you have not taken any overdraft, you have surplus cash, therefore interest is 0. But how much have I spent for this project? 12,30,000 plus 50,000 is spent. So you get 12,80,188, which is spent, guys, which is spent so far. Now come to Feb. In Feb what they are saying, look at this. In Feb what they are saying, however substantial admin work was completed, look at this wording, and again 14 lakhs of overdraft is taken from 1st Feb. 1st Feb I am taking a new overdraft of 14 lakhs. So look at that. So in Feb, even though 2 lakhs is actually spent, you are taking a new overdraft of 14 lakhs into 15% into 1/12. You got a new sanction limit. So interest is 17,500. Therefore the new limit will now be 12,80,188. Previous carried forward, how much you have spent plus new 2 lakhs, what I have spent out of my OD, plus interest alone is 17,500. Interest alone is computed on 14 lakhs. On 14 lakhs. Why, sir, it's computed on 14 lakhs? If you check, it is going to be 14 lakhs into 15% into 1 divided by 12. You get 17,500. Why they have taken? You have the explanation here. Look at this. Yeah. During Feb, regarding the 17,500, I am sure you have a doubt. Look at this. Actual overdraft borrowings was only 14 lakhs. Hence, interest of 17,500 on 14 lakhs has been calculated. Even though actual expenditure on project has crossed 14 lakh 97, cross 14 lakhs. That means, look at previous cases. In previous cases, if you see, they were calculating a cumulative interest on 12 lakh 15, 7 lakh 95 plus 4 lakh 5. But in this case, if you see, our outstanding was 12 lakh 80,188 plus you have spent 2 lakhs. So it becomes 14 lakh 80,188. Even though the spending is more, the allowed OD is only 14 lakhs. That means remaining 80,000 odd, you have put in your own money. So interest is only for 14 lakhs because the limit of OD given in the question is 14 lakhs in the month of Feb. But still we are counting how much we have spent. But again they are saying in the month of March, 31st March, after that look at that, it became from 1st March 30 lakhs. The limit is again increased. So for the last month if you see, they have spent 12 lakhs. From this 1497 we are adding 12 lakhs. The total here becomes 26 lakh 97,688 into 15% into 1/12. Here why we are allowing this in the last month? Because the limit is there up to 30 lakhs for interest. Previously limit stopped in 14 lakhs. So 33,721. Add this as usual. Closing balance. Total spending on principal plus interest is 27,31,409. This amount will be capitalized. I hope you guys have understood, guys. It's a proper detailed sum. I have explained using the solution quickly what has been done. Okay, next question. Let's go to next question, guys. We are done with AS16, AS17 also we finished. Before I go to AS20, let's do one theory, one practical. One theory, one practical type of sum. Look at this, AS24. What is AS24 saying? Let's go to the theory of AS24, guys. AS24 talks about discontinuing operations. Let's quickly see what is discontinuing operation. Yeah, this is the definition of discontinuing operation. What is it? Discontinuing operation is a component of the enterprise. In this standard, you have to know this definition. Component of the enterprise, that the enterprise pursuant to a single plan, very important, one single plan, disposing of substantially in its entirety. The whole component is being sold by demerger, spin-off, etc., or disposing of the component assets in a piecemeal manner and settling the liabilities individually. I cannot sell the whole bike as such, so one part I am selling. So take it like, imagine you have a bike, selling the whole bike as such is point A. I can't sell the whole bike, so one piece I am selling here and there, that is point B. Nobody is buying that bike, throw it, abandon, termination by abandonment. So discontinuing operation basically means in a single plan, whole business is sold or part of business is sold on different days, or termination by abandonment. Classic example, L&T 15 years back used to do construction and cement business. After some time they decided they wanted to focus only on construction, so they sold the cement business. That cement business only today is known as Ultratech Cement. They did not sell because they had a loss, but they sold it because they wanted to focus more. Both were profitable, guys. So if this happens, either you sell the whole business or part or termination by abandonment, that represents a major line of business or geographical area of operations and identified separately for operating and financial reporting purpose. Basically they are saying separate team is there for operating and financial reporting purpose. This is discontinued operation. We are not getting in depth, just a quick concept revision. Now here the standard itself says what is not a discontinuing operation. Gradual or evolutionary phasing out of a product, slowly reducing it over a period of time. Discontinuing even abruptly several products with an ongoing business. Let's say Lay's chips, there are many flavors, blue, green, all of that. They suddenly decided this red flavor we will stop. Slowly they are reducing production. That is first point. Second point, nobody likes red lace. Suddenly they discontinued red lace and many other laces which you don't know, some baked this, everything they discontinued. Or shifting of production facilities. Let's say lace is shifting from Andhra to Delhi. This is not discontinuing operation. And last one, closing of a facility to save some cost. This is also not a discontinuing operation. Now what is the question over here? AS24. Question number 16 says, Arzu Limited is in the business of manufacturing of passenger cars and commercial vehicles. So passenger cars, commercial vehicles. The company is working on a strategic plan to shift from passenger car over to shift from the passenger car in the coming 5 years. Arzu you can take as Tata. Tata has passenger cars, you have this Nexon, etc., and commercial vehicles, Tata bus, Tata truck, everything. No specific plan. Look at this. The definition says, what does the definition say, guys? There has to be a single plan. We started off with the word single plan. So no specific plan have been drawn up for sale or neither any of its assets. As part of its plan, it will reduce production of passenger cars by 20% annually. That means gradual or evolutionary phasing out. It also plans to commence another new factory for the manufacture of commercial vehicles plus transfer of employees in a phased manner. So, phased manner, they are manufacturing a new factory for setting up a new factory for commercial vehicles. You are required to comment if mere gradual phasing out is a discontinued operation. Answer is no. We saw in our notes also. In our notes, what did we see, guys? Look at this. Gradual or evolutionary phasing out of a product is not a discontinuing operation. Second, if the company passes a resolution to sell some of the asset in the car division and also transfer few assets to the passenger car division, basically this is shifting of production facilities. Is this triggering of AS 24? Answer is no. Why? You are just selling some assets and shifting. You are not discontinuing anything. You are just selling some assets in passenger car and transferring few assets to the new factory. There is no discontinuance of passenger car here. Last, would your answer be different if the company resolves now they are deciding to sell the assets of passenger car in a phased but time bound manner? The word resolves means there is a plan, therefore yes, this triggers AS 24. Let's look at the answers for this. For AS 24, look at this. No. The company's strategic plan has no final approval. No. The resolution is salient about stoppage of car segment in a definite time. Those sale of assets and some transfer proposal were passed through a resolution to new factory. Closure roadmap is missing. Yes. Phased and time bound manner. Resolved in a board. Resolved. The word resolved is important. With a clear roadmap. There is a definitive plan. Therefore, it becomes discontinuing operation. This is about AS 24 question. ICAI has only this question since whole syllabus keeps coming again and again. Before we go to the last two theory questions in AS, let's do one more sum. That is that last sum based AS question in our RTP discussion, AS 20 rights issue. Let me explain this rights issue for you once before we proceed, guys. Rights issue is very simple. Follow. The logic alone I will not explain here. I am going to focus on exam oriented steps. Okay. Now, rights issue might happen sometime during the year. So, beginning of the year I might have 1 lakh shares. Just taking some random numbers before we go to our question. During the year I issued rights issue plus 50,000. So, end of the year I might have 1,50,000 shares. Now, follow, guys. Before the rights issue, the price per share, market price could have been 30. Rights will be given, let's say, at rupees 20 rupees. So, after rights, share price might come to 25. So, look at this, guys. I am just giving a random example before we go to sum. Before rights, market price is 30. In rights, shares are given at a discount. So, after rights, share price has dropped because there is some free element given in the rights. That means, when you do a rights issue, there is something called a bonus element in rights. What do you mean by bonus element in rights? Bonus element in rights means while giving rights, there is some free element. So, after rights, in the right hand side, we have new rights where shares are issued not at face value, little less, therefore, there is some free element over here. In the left hand side, there is no free element. So, what I have to do for the opening shares, I have to add the free element. For the left hand side, I have to add what, guys? the free element has to be added. This is the crux logic. What are the steps for us in AS 20 guys with respect to rights issue? Very simple. We are exam oriented discussion over here. We are having only exam oriented discussion. So first one, compute theoretical X right price. When a right sum comes, you have to compute theoretical X right price. What is theoretical X right price? Look at this sum. In this sum itself, if you see, I will show you how the theoretical X right price happens over here. See guys, how does the theoretical X right price happens? Very simple. Before rights issue, one share was 1 lakh, number of shares was 1 lakh, and price before issue was 30 rupees. Additionally, I issued 50,000 shares at rupees. How much guys? 20 rupees was our example, divided by 1 lakh shares plus 50,000 shares. So, existing number of shares are 1 lakh, existing market price is 30. New issue is 50,000 at 20. What is the meaning of this? If I multiply 1 lakh into 30 plus 50,000 into 20, you will get, what you will get guys, look at this, 30 lakhs plus, so 50,000 into 20 plus 30 lakhs, you will get 40 lakhs. So this 40 lakhs is the overall investment of mine in the company. In this 40 lakhs, if I divide by 1 lakh 50 divided by 1 lakh 50,000, you will get, we wrote roughly 25, you will get 26.67, correct? The equation here says the total investment by you is 40 lakhs for shares of 1 lakh 50. So one share is worth 26.67. This is called theoretical X rights price. Look at this. Share price before rights, how much you invested divided by total number of shares. In this what we will do, here what we will do is, the next step is to, this is step 1. Step 1 is computation of theoretical X rights price. So let's do with our actual sum itself. So we will save some time. So look at this question. The following information is available: 22, 23, 22 lakhs, 23, 24, 30 lakhs, and they have given number of shares before rights issue is 10 lakhs, 1 share for every 5. So 2 lakh rights issue price 25, last day to exercise 31st July, before issue it was 32. So how do we do that right steps guys? Follow what they are saying in this question. If you see, number of shares are 10 lakhs, correct? So we will just write it down. Number of shares before issue is 10 lakhs. Then rights exercise is 31st of July. Before the issue it was 32. So it was at 32. 31st of July rights is being issued. That means 7 months. Okay. Then rights are issued 2 lakh shares at 25. So I have 2 lakh shares at 25 per share. What happens post rights issue? So what is the total investment I have in this company guys? Overall value. First step is to compute theoretical X rights price. So that will be 10 lakh shares into 32 initial overall company's net worth, plus now new net worth is 2 lakh shares into 25 whole divided by 10 lakhs shares plus 2 lakh shares. How much you will get here guys? So you will get, we will get over here, yeah, now we will get 10 lakhs into 32 plus 2 lakhs into 25. Total you will get numerator 325. We will get 3 crores, 32 crores 50 lakhs. Okay. You will get 32 crores 50 lakhs divided by 12 lakh shares divided by 12 lakhs. We will get roughly, let's cross check the answer. AS20 on top. Yeah, there are, yeah, here it is. So exactly what we did, 32 into 10 lakhs plus 25 into 2 lakhs. We did the same thing. 32 into 10 lakhs here, 32 into 10 lakhs plus 2 lakhs into 25 whole divided by 12 lakhs. Whole divided by 12 lakhs. Some calci issue here. You will get, the answer will be 30.83. So we will get answer of 30.83. Here also we will get 30.83. What is step number 2? Step 1 we already did. Step number 2 is something called computation of rights adjustment factor. Here the logic is, before rights issue share price is 32, after rights issue share price became 30.83. So if I divide 32 divided by 30.83, you will get 1.037, which means for every one share 0.037 is free. Look at this, 1.037 approx rounded off to 1.04. Sir, what is step 3? This rights adjustment factor should be applied on the opening number of shares. So opening, how many shares we have? 10 lakhs. So 10 lakhs is the number of shares before rights. Now add the free element. So into 1.04. So if I apply into 1.04, 10 lakhs into 1.04, common sum guys, many times we have done this. I am teaching you without logic here, just doing the sum for you. 10 lakh 40,000 is the value before rights issue over here. So now when you come here to compute your earnings per share, we will compute first earnings per share for current year and then previous year. Okay. So for previous year, let me do it with, we will do it our way itself. So we have profit is 22, 23, 23, 24. So for 22, 23, yes. So for 22, 23, let me do it in a simple way. Book, it's little confusing. So when I write the net profit here for 22, 23, it is 22 lakhs, 22 lakhs, and current year it is 30 lakhs. Current year it is 30 lakhs. When I compute gains in denominator, first case I will just take what shares are there last year. So last year I will write 10 lakhs because that only is there. So your EPS will be 2.20. First case is ignore everything. What is the EPS last year without adjusting for rights? So without adjusting for rights, you will get 2.20. Now after adjusting for rights, how much you will get? After adjusting for rights, we just now computed, if rights were given last year, the free shares to be included is 40,000. So now I will divide by 10 lakh 40,000 and you will get 22 lakhs divided by 10 lakh 40,000. We will end up with 2.11, the same answer over here, 2.12 rounded off, 2.12 rounded off guys. Now coming to this year, so this is previous year without AS20, this is previous year with AS20 treatment. Now in current year, what is happening? How do I compute gains in the current year? Look at this, In the current year, it is only for the first, how many months guys? Rights is given, rights is coming on 31st of July, correct? So, if rights is coming on 31st of July, from 1st April, you have 4 months here, April, May, June, July, and then you have the next 8 months over here. So, for the first 4 months, I will consider 10 lakh 40,000 into 4 by 12 plus for the next 8 months, I will take 12 lakhs into 8 by 12, because for the first 4 months rights was not there. So, I am including only the bonus element in rights. Next 8 months I am considering the full thing. Same workings that are done here. 10 lakhs into 1.04 is nothing but 10 lakh 40,000 into 4 by 12 plus 12 lakhs into 8 by 12. You will get the veins. How much will that be? 10 lakh 40,000 into 4 divided by 12. You will get 3 lakh 46,667 plus 12 lakhs into 8 divided by 12. You will get 8 lakhs. So, your denominator will become totally, we will get 11 lakh 46,000 here. You will get divided by 11 lakh 46,667. So, 30 lakhs divided by 11 lakh 46,667. You will get 2.62 is your answer for your EPS. So, basically what we are doing in the current year, this 11 lakh 46,667, 11 lakh 46,667 is the answer for this. What we are doing, current year 8 months, after rights, we are just taking whatever shares we have overall, 12 lakhs into 8 by 12 for veins. Before rights, why we am taking 10 lakh 40? Before rights we had only 10 lakhs, but I am adding the bonus element 10 lakhs into the rights adjustment factor of 1.04 or 0.04. So, 10 lakh plus 40,000 is the free element, bonus element in rights, which is added previously also. So, into 4 by 12. These are the 3 answers. So, let us proceed to the next sum. AS20, this is a very usual sum. We need 45 minutes, 1 hour to just discuss this sum in detail. If you want with 100% logic, again I am telling you, I am not solving here with logic. I am just going with the sums, steps we have that we do for exam and what you have to do for exam guys. So, this sum also is done. We will proceed further. We just have another 4 questions left, 2 theory and 2 practical sums. Let us quickly compute those. AS28 talks about impairment. Impairment of assets, we have something called CGU and non-CGU. So, if I go to the notes of our AS28, impairment of assets, okay, you have a concept called CGU, cash generating unit. That is what they are checking here. What is cash generating unit or what is an asset? This standard says if an asset can stand alone by itself generate revenue, it is treated as a separate cash generating unit. For example, one Ola cab or one taxi by itself independently it can generate cash. It is a separate CGU. No sir, not possible. Then for example, in this class, camera is recording me and we are recording this class. Camera separately can't record any or generate any revenue, but the class all put together, this pen, this system, this camera, the AC here, the lights here, all of this put together only can generate revenue. Students are coming to class for everything put together. So, the camera cannot work independently. Camera along with all the assets are working. Then the CGU, what happens over here? We will call it becomes a part of the CGU. So, we will not treat it as a separate asset. We will call it CGU. So, in simple, the Ola cab example, the cab example I gave you is a separate individual asset that can generate cash flows by itself. But the camera over here is not a separate individual assets. This belongs to a cash generating unit. Multiple assets put together that can work together and they can't work independently. So that is the definition. What is a CGU? Smallest identifiable group of assets. This camera, classroom, everything generating cash flow independently from other group of assets. So this classroom is different from other classroom. Are you following, guys? Okay. Just a quick revision of this concept. A publisher owns 150 magazine titles, out of which 70 were purchased and 80 were self-created. Now each of this magazine is one asset, or should I treat all the 150 magazines as one CGU? The whole chapter is this. Basically, these 150 magazines, can I consider them as 150 separate assets, or these 150 magazines will become one CGU and I will treat it as one? It depends whether these 150 magazines can separately, independently generate cash flow for me, or they can generate together. Let's read the question. The price paid for purchased magazine title is recognized as an intangible asset, copyrights. The cost of creating magazine title and maintaining existing titles are recognized as an expense when they are incurred. Cash inflows from direct sales and advertising are identifiable for each magazine title. This is the keyword. Let me highlight this again. Look at this. Cash inflows from direct sales and advertising are identifiable for each magazine title. Titles are managed by customer segments. The level of advertising income for magazine depends on the range of titles in each magazine. So, the previous sentence, this part is the most important. Which one? First line, cash inflow from direct sales and advertisement are identifiable from each magazine separately. Management has policy to abandon own titles before the end of their economic life and replace them with new titles. Will this be a CGU as per AS 28? Answer is no. This is not a CGU. Why, sir, this is not a CGU? Simple. Look at this. It is likely that the individual magazine in this 150, each individual title can generate cash flow that are largely independent from another, and therefore each magazine title is a separate cash generating unit. What they are trying to say, whatever I said now, in this 150 magazines, each magazine by itself can generate cash flow separately, not dependent on the others. Therefore, it is not a CGU. If a scenario comes where everything works together, all magazines is part of one package, then it becomes one CGU, because then they are dependent on each other. Following, guys, let's go to the next theory question, AS 29, last question that we have in accounting standards, and then followed by one simple question buyback and one branch. We have a debtors method in buyback, not MCQ. They are asking basic journals, very basic journals, guys. 3 questions, 15-20 minutes. We will close and proceed. Okay, follow, guys. A company under Section 8 of the Companies Act 2013, having main objective to promote trade by organizing trade fairs, okay, Section 8 company. When company was organizing the trade fair, exhibitors decided to charge 5% contingency charge for the participants outside agencies on income received. So if I receive, if 1000 rupees is the ticket, 5%, what is 5%? 50 rupees, because 10% is 100, guys, 5% is 50. This 50 was charged separately as contingency. Why? This 5% are charged separately in the invoice. Additionally, I am charging the contingencies in respect of fairs organized by company itself are inbuilt in the space rent charged from the participant. Whatever they are doing through third party or by themselves, they are charging contingency. It's like, let's say you're buying 200 rupees to go watch a movie in PVR. Additionally, they're collecting from you 20 rupees for some contingency. What is the contingency? Both are credited to income and expenditure account. That means if they're charging 1000 rupees, extra 50 also is contingency. Both are treated as income. The intention why I am charging this, of levying these charges, is to meet any unforeseen liability which may arise in the future. For example, loss due to visitors, due to fire, terrorist attack, stampede, natural calamities. If something happens, to save you, I need more money so that I can help you. Okay. Or giving you, compensating you for any loss or any death, etc. The chances of occurrence of these events are high because of large crowd. Okay. The decision to levy 5% was based on the assessment as actual liability cannot be estimated. Two questions. The following accounting treatment was done by the company. 5% contingency charges are treated as income and matching provision also is made in the accounts. What they are saying, 5% income is shown, similarly 5% provision is shown, so I am setting off both. A suitable disclosure also is made in the books of accounts. I hope you are understanding, guys, what company is doing. If 1000 rupees is income, they are charging extra 5%, 50 as a additional income and also creating a provision for this, like this. Why they are doing this? For some safety if something goes wrong. They are asking, is this fine? Let's go to AS 29 once and read the definition of provision, because then only you will understand. What is provision defined as, guys, in AS 29? It's 3 points. You have to satisfy all the 3 points of the definition. What is that? First, there is a present obligation arising from past events. One second. Okay. Present obligation arising from past events. Let's take an example of income tax is a provision that we create. Provision on income tax. Because I earned income in the last 1 year, in 31st March I create a provision. Present obligation to pay tax because of past events. The settlement of liability will result in outflow of resources. Yes, if I am going to pay tax, outflow of resource will be there. Reliable estimate can be made. How much tax I don't know, but approximate 30% provision I will create. Later, when you do tax audit after few months, as per income tax provisions, you will get the exact tax, disallowance, add depreciation, reduce, all of that. So provision means 3 things have to be satisfied. If this is A, this is B, this is C, it's not A or B or C. A, B and C, all 3 should be satisfied. What is it? Repeat with me in your house. There is present obligation from past event, settlement of liability will have an outflow of resources, last one, reliable estimate can be made. Okay, Paka. Now come here. Now what they are saying, the question they are asking is whether creation of provision for contingency under the facts is allowed. Look at the provisions, guys. First, reliable estimate should be made. Read the question. Is there a reliable estimate? The question itself says, look at this paragraph, based on actual liability cannot be estimated. Reliable estimate cannot be made. That means this point is not met. And also for provision, one important thing, look at this. Provision for income tax means I have to pay tax now because of some past event of me earning income in the past. There is a present obligation arising from past event. Do I have any obligation here? Contingency. Do I have any obligation here? Nothing has happened. Nothing bad has happened yet. Therefore, you cannot create a provision because the definition of provision is not met. There is no present obligation from past event. Reliable estimate cannot be made. In case the answer is no, it's no only. Like this question, it will be no. Then what should be the treatment of provision which is already created in balance sheet? Sir, already I created 5% debit. So my entry is P&L account debit to provision. So in balance sheet, I have a provision which is like a liability. No, this is not a liability. This is like a saving. You have saved money today for the future by reducing profit. So don't call this provision. Call this as a reserve. So this will be treated as a reserve and not a provision. This is like transferring money from your P&L to general reserve. It's like a reserve saved for some contingency in the future. This is what AS 29 says. If it's not a provision, it becomes a reserve. Last two questions, guys. Let's go to the last two questions. Follow. Let's proceed. Buyback and branch accounting. Buyback and branch accounting, guys. Buyback, simple question. Propose resolves to buy back 4 lakh of its paid up equity shares of 10 each at 22. Let's simultaneously solve. They want to buy back 4 lakh shares, face value 10 at 22. That means how much they are going to pay? 4 lakhs into 22 is going to be 88 lakhs of cash outflow is going to be there. Okay. The buyback is in compliance with the provisions of Companies Act and does not exceed 25% of the company's paid up share capital. So they are saying section 68 of the Companies Act is properly followed. For the purpose, it issues 1 lakh preference shares of 10 each. So what they are saying, for this purpose, preference shares, new preference shares, I am issuing 1 lakh preference shares of 10 each, which is 10 lakhs additional cash inflow is coming in. Okay, next, of rupees 10 each at par they are issuing, the entire amount being payable with application. Super, full 10 lakhs I am collecting now itself. The company uses 16 lakh of its balance in securities premium apart from adequate balance in general reserve. That means 16 lakhs of SP is used, which is allowed as per section 52, it is allowed. Now regarding buyback, give necessary journal entries. Very simple. First let's do computation, guys. For buyback, what are the entries you should do in this sum? If you see, first you have to do issue of preference share capital, bank account to share capital entry. Next, you have to do buyback entries. You guys know the entries. One is transfer entry to shareholders. One will be payment entry. Next entry will be transfer to CRR. How much to transfer to CRR? CRR transfer logic. You just search on YouTube, you will find it, guys. Why to transfer to CRR? I will only be taking it over there. Why to transfer to CRR? Separate long discussion. One of my favorite concepts, why we transfer to CRR, beautiful logic. But come back over here, why do we transfer to CRR? Logic, we will go with the formula or equation that we have. It is basically face value of shares brought back minus new issue, if any. Face value of shares brought back here is 4 lakhs into 10, which is 40 lakhs minus new issue 10 lakhs. So you will transfer to CRR only 30 lakhs will be transferred to CRR. Sir, what about the other entries? Issue of preference share capital, look at the entries, guys. Easy one, bank account to preference share application, preference share to allotment, 10 lakh, 10 lakh, 10 lakh is done. This is simple. Transfer to CRR, just now we computed 30 lakhs is going to be transferred to CRR. Look at that entry. General reserve to capital redemption reserve, 30 lakh and 30 lakh is done. Now coming to the main entry. Sir, what is the entry for this 88 lakhs? So what is the entry for that? Look at this. To equity shareholders account is going to be 88 lakhs because I am going to pay them 88 lakhs, and next entry will be equity shareholders account debit to bank, which is 88 lakhs, correct? Now what reserves I will, this is the payment entry, guys, this is the payment entry. I have to pass the due entry. Two equity shareholders 88 lakhs, but in this I will debit my equity share capital face value only I will debit, which is 40 lakhs I will debit, guys. So in this 88 lakhs, if you see, face value of share capital is 40 lakhs, which is given in the question, 4 lakhs into 10. Remaining 48 lakhs I should use from my reserves. In this question already told, from securities premium you will use 16 lakhs. Therefore, if you do 48 minus 16, remaining 32 lakhs you can use from your general reserve. So that is how my entry will be here, guys. My entry will look like, entry here will look like securities premium account debit 16 lakhs. Therefore, balance general reserve account debit 32 lakhs will come here. So the total debit to my general reserve is going to be 32 lakhs here plus 30 lakhs for transferring to CRR. 62 lakhs will be debited. Look at this, 30 lakhs for CRR, and now I will pass SP account debit 16 lakhs, general reserve account debit 32 lakhs, to premium payable 48 lakhs, guys. So total usage of general reserve is going to be 62 lakhs for me, 32 lakhs for the purpose of buyback in 68, 30 lakhs as per 69 for transferring to CRR. This is about this question. Same computation here, 40 minus 10, 30. Fairly simple, easy question of buyback for 6 to 8 marks. If this comes in exam, you can easily score. Now going to the last question left in branch. But before that, one small discussion for just 5 minutes. If you looked at the RTP, guys, look at this. You have to be smart for the main exam. Some chapters like consolidation, amalgamation, internal reconstruction, schedule 3, branch, and AS3, cash flow and buyback, guys. Just these chapters, even though we don't have in the RTP, if you master this, 50 to 60 marks are in your pocket. This is one side. All AS is on the other side, which is another 50 to 60 marks. So totally you will get 120 marks including choice. Believe me, guys, accounting standards, lot of concepts are there. Only when you learn in detail, interlinking is possible. Those concepts are important. Here we are only exam oriented, solving the sums. Before I go to branch, just one small discussion for all of you over here, guys, those who are watching the recording. I just want to ask you all one question. You all must be having a dream in life, whatever it is, small or big. For example, some of you might, however rich your parents are, however well off they are, no sir, they are not well off, financially we are from middle class, doesn't matter, guys. Anyone can have a dream. Elon Musk came from zero. He built his empire by himself. He didn't have a family background. So if Elon Musk can do it by himself, you can have a dream, small dream, like buying a car for your parents. Some people will be like, I want to build a house for my parents. Some of them for themselves, sir, I want to buy an iPhone, sir. Many people have that as a dream. For some people, they want to travel the world. They want to go for a world tour. Remember, guys, what is your age? Those who are watching, I am presuming most of you are in the age group of 18 to 30 years. Some of you could be even 30 plus, working now, left CA, came back after some gap, or you are in your 40s, doesn't matter. Majority of you must be in the age of 18 to 25, doesn't matter, guys. Whichever age you belong, you still have life left, another 20 years left, another 30 years left, another 40 years left in your life. All of these dreams are possible. Remember, miracles do not happen, guys. You will not go win a lottery. if you want to change your life, the only person who can change your life is you. The only person who can change your life is you. Now look at the date and time over here. We are recording this marathon. You can see the taskbar over here. I don't know how many of you noticed. 19th August at night 12:18 am. 12:18 am on 19th August. That means I am recording this at a continuous stretch. Started at around 9:30 p.m. Around 9:30 p.m. we started. Middle had one small 10-15 minutes water break. Now we will complete another 10 minutes. So let's say by around 12:30 am I will finish it. Today is 19th August, which is a Sunday night. Sunday night when my family is out, wife, kids, they are all gone out. I am sitting in the academy here. We have 1-2 students who are helping me out. Night at 12:30 am, why should I record this? Because other days during the day I might have class, I might have other work. But I decided for our academy and for our students, we have to do the RTP. It should go out to you very soon so that in about 2-2.5 hours you are able to revise the whole thing. Am I going to gain anything great out of this? No, you can do it by yourself. If you search on YouTube, you will find many RTP videos. But why should I do it for you? Because you have studied the class from me, you have studied it from us, and then you have used these notes. And our class, we have done all the study math sums except these RTP sums, which are new sums we are going to discuss. Because end of the day, remember guys, for you to achieve any of your dreams, your first step is your September 24 exams. If not, if you are writing Jan 25 also, these RTP questions are important for you, because from RTP, at least 1 to 2 questions in the main exam will 100% come. Remember again guys, your life will change only with efforts from you. If you put the efforts, it is never there in the history somebody who has put efforts have failed. Maybe success would have been delayed for them, but keep putting your efforts. This is one small thought I wanted to share with you, because I have seen that if those who keep putting the efforts, one day they will get the success. Do not compare yourself with somebody else. Sir, he is lucky, I am unlucky. No. Luck is different. If you put in effort, luck will come in search of you. Okay. Now let's proceed to the last question of our marathon, which is branch, which is a simple question, but we are doing this because this type of question is not there in the study mat, meaning little bit extra adjustments. Okay, look at this. From the following particulars relating to the Pune branch for the year ended 31st December, prepare branch account in the books of head office. So if I have to prepare branch account in head office, this is nothing but debtors method. Instead of me solving this full sum, I am just going to tell you shortcut as to how to solve. Look at this. They have given opening stock and then they have given opening debtors, closing debtors, opening petty cash, opening furniture, opening prepaid fire insurance, opening salary outstanding. These things are not there in the study mat. That is why we are doing this sum. You should not get confused. Sir, always opening debtors, stock and cash only will come, sometimes petty cash. Now what is this furniture, prepaid fire, salary outstanding? Those who know branch account logic, whatever is there in balance sheet of the branch at the end of the branch will come as closing and opening balance. It could be any asset, any liability. Similarly, come down, you can see closing stock and then you have closing debtors, which is there on the top. So first thing that you do in a debtors method sum is write down all the closing and opening balances. I am going to explain from the sum guys, so it's easy for us. Look at this, all the opening balances which is there in the question, including opening salary outstanding. Like this, we don't have any sum in study material where there is an opening liability. This sum is not difficult. This sum is only testing your concept. If something new comes, do not panic in the exam. Do not panic in the exam, guys. So everything opening is written. Closing also, whatever available we will write. Stock is available, I will write. Petty cash we have to compute. We will come to that later. Debtors is available in the question. Look at this. In the question, debtors is given on the top itself. Closing debtors is 4,900. I am copy pasting 4,900. And opening furniture is 2,000. And below they have given provide depreciation on furniture at 10%. So 2,000 minus 10% will be 1,800. That only I will write here. Closing furniture is 1,800. All of this is written over here, guys. And last closing balance, look at this, annual insurance, prepaid. Yeah, if you take prepaid fire insurance, premium on 1st Jan 150, the same thing is repeating, prepaid insurance 150 in the end. That is because annual insurance is there up to 31st of March 600. So if 600 is up to 31st of March, I am preparing only up to 31st of December. That means 31st of December only is enough for me, but you have paid up to 31st of March. That means 3 months extra is paid, which is my prepaid. 3 months extra is paid, which is my prepaid, guys. That only I am showing here, prepaid insurance. So what I have done so far, guys, nothing great. I have just written down all the opening and closing balances. Closing balance alone, furniture small adjustment for depreciation, prepaid. I am doing one small, 3 months I have paid extra, so I am taking it as a prepaid closing balance. Okay. Now, remaining things, goods sent to branch during the year 80,000. This is like purchase for the branch. Look at this, goods sent to branch like a purchase, 80,000 debit. Next one, cash sales during the year, credit sales during the year, cash received from debtors. You know, in debtors method, guys, in debtors method, we don't account directly transactions happening at the branch. We account only those transactions in which head office is involved. So this we will see later. Cash paid by the branch debtors directly to the head office. I will record this 2,000 because head office is directly collecting this 2,000. So where is this 2,000 coming, guys? By remittances. What all cash branch received? Look at this. What all cash branch received? It will go from branch to head office. Cash sales, cash received from debtors. Every sum we do this. Cash sales, cash received from debtors, cash paid from branch debtor directly to head office. And in the question they have given downward new adjustments. Good costing 1,200 were destroyed due to fire and 1,000 was paid by the insurance company. So 1,000 is paid by insurance company. So 1,30,000 cash sales, cash received from debtors 35,000, cash paid by debtors to head office 2,000, cash received from insurance company 1,000. Add all of this 1,68,000. Why is this on the credit side of branch account here? Because head office will get this remittance back. For them it's debit, for branch it is credit. So I hope this also you have understood. So we have finished accounting all of this. Credit sales at the branch, I don't care. I don't care about this. We should not care in this sum because what is happening at the branch without head office involvement, we don't account. Next, discount allowed to debtors, we don't see it here because they already gave opening and closing debtors. This is irrelevant for me. Next, cash sent to branch for expenses. So head office sends some cash to the branch for rent, salary and petty cash. Take these two, 2,000 and 2,400. Look at this. Cash expenses for branch it is a debit like receipt and it's like the P&L. Remember guys, branch account takes two forms. It is both balance sheet and P&L in the same account. I am again repeating guys. Branch account takes two forms. It reflects balance sheet and P&L in the same thing. So expense also will come on debit side. Any asset also will come on the debit side. That is why here rent and salaries 2 and 2,4 is coming on this side. Do not watch this if you are just studying branch for the first time, you will get confused. Only if you know the chapter, look at this. Rent 2000, salaries 2400, petty cash 1000 came, insurance also they paid 600. So petty cash 1000, insurance I paid 600. This is the total expense 6000 which the head office sent to the branch, which I am putting as an expense over here. Now look at this. All items we have discussed 1, 2, 3, 4, 5. These are all opening balances. Goods sent 80,000. These are all expenses at the branch which is sent by head office. Debit side fully we have accounted. Credit side opening balance accounted. All the remittance also we have discussed 1,68,000. Now next one adjustment, goods returned by the branch. So if branch is getting goods debit side, if branch is sending the goods back to head office 1000 rupees and then 1000 rupees if it's sent back, and then closing stock of stock we wrote to petty cash we will discuss in next minute. This is done, debtors is done, furniture is done, prepaid is done. So you get everything we have discussed over here guys. So you get net profit. Sir, how do you compute petty cash closing balance? Very simple. Opening is given in the question as 500. During the year I received another 1000. So look at this. Opening 500, during the year I received 1000. Total 1500 is available with me. How much petty cash has the branch spent? Look at this. Petty cash spent by the branch is 850. So if I simply prepare a cash account, opening 500, received 1000, spent 850, my closing will be 650. This is your closing 650. 650 is coming in the branch account, and this is how you are going to prepare the branch account. I have not solved the sum using the solution. I am trying to explain in 5 to 10 minutes guys. Idea is I don't want to make a 5 hours video for RTP or 6 hours video for RTP guys. You don't have 6 hours to watch the full RTP. You just have hardly 2 to 3 hours. So instead of watching a movie, if you guys finished watching this RTP September 2024, and if you are writing the exam in September 2024 or Jan 2025, I can assure you guys that this 2 to 3 hours is going to be worth it if you know all these questions either in your September 2024 exams or Jan 2025. From this 2 to 3 hours of discussion, at least 5 to 10 marks will definitely come. So once it comes in the exam and once you have solved it in the exam for spending this 2 to 3 hours, come back to the comment of this video after the exam and type, "Sir, I spent 3 hours. This came in the exam. Thank you sir, I got 5 to 10 marks. That is more satisfaction for me than anything else." So all the best for the exams guys. Go give your best. You always have our blessings. All the best guys. Do well. Thank you so much.